I'm Keith McCullough, and welcome back. It's going to be a good day. As we like to say, we're going to have a good day. Good friend of Yale hockey, one of the great Yale alumni out there, Jim Chanos. Thank you for spending some time with us today. I know the audience is quite excited about this discussion.
Oh, glad to be back.
Yeah, it's good to have you back. Now, I have to start, and I started with this with Carson Block yesterday, and we could talk a little bit about him as well, but more so top down. You know, I've been short selling for 20 years. You've been doing it for a lot longer than that. And we're in this moment in time where all these different narratives compete with actual numbers. It can be frustrating, it can be exciting. I like to think of it as an exciting moment in time where, you know, making short selling great again is pretty straightforward. There are a lot of different opportunities, but I wanted to, you know, fully loaded, just kind of take your pulse on the kind of short selling environment we have relative to the ones that you may have seen before.
Well, I guess I could segue into that by mentioning what Carson said somewhat memorably yesterday on your interview, that he sort of likes to he basically leans into short selling. He likes to F around. And sadly, I think for short selling for the last 10 years, short sellers have mostly been the FE, not the FR. And I think that's, you know, a lot of us exhaustion is setting in because things have gotten in our corner of the world silly and then sillier. And what we're seeing now is really the advent of just all kinds of questionable business models being promoted and going public, and it's not about Apple. It's about space travel, and I think that it's a big difference in terms of the speculative environment a few weeks ago, or a few years ago versus today. You've got a much more speculative element in the markets, really since late last year. Since I think when you and I sat down the last time, you saw the advent of retail speculation starting in the fourth quarter of 2019, pre-COVID, and it's continued right on through 2020, which is making this year so sort of fantastic in terms of the swings in the marketplace and the valuations on really questionable businesses, things that you and I would have probably laughed about 10 years ago. Could you believe people did this in 2099? And they're not only doing it again, but they're doing it in magnitudes greater amounts.
Yeah, and we'll get into that in particular on the SPACs. I mean, that's a blazingly obvious one to many of us. But just to take a step back on like market structure and what's been frustrating for a long time for short sellers, slide 4 guys, is just this shift, you know, where we have the indices. To your point, it's, you know, used to be actually all about Apple and Microsoft and the 5 stocks driving the index. So you'd have a tough time fighting that market beta. But then, you know, post that, you know, that 85% of daily trading volume was systematic at one point pre the hoodies coming into the game. Now 15 to 20% of it, I would just say, isn't that just the point? You know, whether it's 50 or 70 million retail brokerage accounts interacting on the edges of volume every day, that's what's really perpetuated it. I mean, they chase narratives. I mean, you've seen outright frauds being chased. You've seen bankruptcy stocks being chased. I've never seen anything like this in 20 years.
Well, in more, shall we say, normal markets, pretty strong evidence of wrongdoing at a company will generally put a valuation black cloud over something, and the bulls and bears can argue. But in this environment, similar to, again, certain periods we've seen in the past, the advent of a negative story is actually a positive. It's a positive factor. And so a short interest is a positive factor. People pointing out accounting irregularities is a positive factor. And it's only when the companies admit to it themselves, a la Wirecard or Luckin, that you get the re-rating, and then it happens all at once. But up until then, now companies are getting the benefit of the doubt in any questionable story.
Yeah,
that's unusual.
Yeah, and if you guys, you can show that. That's actual data. Jim is obviously always actuarially talking about numbers as opposed to narratives. He'll mix the narrative in with the numbers. But if you show factor exposures, I mean, high short interest as a factor exposure has been just an epic long. I mean, it's up over 23% in the last 6 months. So it's a big thing for us to fight, but that's also why I say, Jim, like I'm excited about it. Like when I see a stock like Nikola, where it's actually now not even a debate. I mean, you have all you have to deal with now is the short interest and dealing with that day to day. But I mean, it could be a moment in time. I mean, most bubbles, as you know, I mean, they're only obvious when you look backwards. And a bubble is something that stops going down and then makes a lower high and then starts to go down faster. And that's actually what the Nasdaq just started to do, or a lot of these kind of story stocks started to do today. And I think it's kind of a very interesting day to be having that discussion as a result. Do you agree or disagree? Do you think it's going to be tough sledding into the end of the year, or it's kind of an open hunting season finally?
Well, first of all, let me correct you, Keith. Nikola hasn't revealed any fraud this week, okay?
Fair point.
I think it's on firmer than you might think. I mean, look, no one ever knows. I remember in March of 2000, the market just started going down, and there wasn't a catalyst. The Fed had not raised rates. It was raising rates during that whole period, and there was no corporate announcement. But come around March 10th or 9th, I'm forgetting the exact day, the market just stopped going up and started going down. And it was an intergalactic bull market peak. We just didn't know it. But again, there were no catalysts. There were no, in hindsight, oh yeah, it was obvious that week that things were going to change. And we don't know. I mean, who knows? I mean, I tried to avoid, picking market tops and bottoms because I'm not very good at it. But certainly things are getting sillier and sillier and sillier. You mentioned the bankruptcy stocks. We've got this incredible SPAC mania going on, where companies that couldn't dream of going public and couldn't pass an underwriter's test now are able to go public seamlessly through a SPAC. I think we're getting about 4 or 5 filings a day now. I think we're up to that. And so the one thing I do know from my 40 years is that given enough time, Wall Street will do a very, very good job in creating supply for people that want to pay up for questionable or worthless assets.
Yeah, Wall Street creating supply, that's a great way to think about it. It's also, they create demand on the narrative side politically. Now, you had some thoughts on this Kudlow reveal. It's not like you could see it happening. You just needed somebody to report it, just so you have the names and the numbers and whatever. But that's disgusting. I think it's disgusting. Do you agree or not? And what part of that? Like we actually have an administration that's trying to prop the frickin' thing up every day.
Yeah, I mean, I think the story crystallized. What that story crystallized for me is just the political divergence that we have, and sort of the feeling out there amongst the general public that the game is rigged. Look, David Tepper, who's mentioned in the article and who's a friend, mentioned on CNBC, around the Super Bowl that, he was getting concerned about coronavirus. And lots of hedge funds were beginning to talk about it at the very end of January, early February. But the problem is that I think what crystallized that story, and people know my political leanings, but it's just the feeling that the public was getting one set of briefings from White House spokesman, not to worry, it's mostly contained or all contained, and then donors and insiders were getting a different set of more worrisome briefings inside the White House. And it just gets to the whole idea of just that's out there, both on the left and the right, that there's two systems here. There's a system for the corporate class, the financial class, and then there's a system for everybody else. And I think that and COVID has just made that worse.
Well, it's certainly made, like the feedback I get, I interface, as you know, with a lot of money managers across, different strategies. And there's a class of just kind of like, I don't know how else to say it other than like, haha, Keith, you're an idiot. You're not plugged into when this is going to happen. And that really pisses me off. Like, you know how I am. I mean, I just don't, like, so I side with, the people, and I always have tried to, and I think that's what the country's all about. But I mean, how does that end? Does it matter? Like, I mean, really the haha comment is like, yeah, you embrace the game, suck it up, and... Yeah,
and it would obviously it gets back to the would you Would you rather be right or righteous or make money? But it also gets back to the tail risk. If you want to be a really wise guy about it, and that torches and pitchforks are undervalued. In that you continue this type of political animus where the 1% or the elite are brought under the tent and everybody else is left to fend for themselves. History tells us that's not a tenable position for a long period of time.
No, you don't want to be in the tower when the square is getting fired up at this pace. Okay, let's just hit on a couple topics. I mean, one in particular that you just brought up, specs. Yeah, I mean, the accountability seems to be zero. There are some that we found. Hopefully, our research analysts are right. There are not frauds. They're actually pretty good stories that have underlying cash flows and assets, kinds of things that we would like. But there are a lengthening list, to your point, just by virtue of the numbers of issues out there, where it's just I don't know what else to say. CNBC trots these people out and they pump and dump on their book. I don't know about the dump side, but there's certainly the pumping going on.
Well, to talk about SPACs, you also have to marry that with the other concept that's driving the narrative side of the stock market, and that's TAM, total addressable market. Because a lot of the more egregious SPAC stories are TAM stories, right? That there's no profitability, but there is this monster market that if their algorithm, their piece of software, whatever it is that's got people excited, works, that it's just a ridiculous amount of money that they can capture from these giant markets. So think about WeWork, which never got public, disrupting the subleasing of office space. Think about Lyft and Uber, which had a monstrous TAM when they went public, of disrupting basically all types of transportation. And now you're getting to kind of the absurd stuff. And we always look for companies where the business model itself is inherently and structurally unprofitable, but they try to dress it up as some sort of network effect TAM story. So consider a recent SPAC by a well-known promoter that is now in the house flipping business. And so they've taken a company that will digitally buy your house and have built a story around this and merged it into their SPAC. Now we have companies already doing this. Zillow, which is publicly traded, has a house flipping business, and it loses money on every house and makes it up on volume. And when you have business models that have discrete money losing aspects to that have no network effect, mainly you lose money on every widget but make it up on volume, you have a bad business. And if you flip houses for losses, or you sell used cars at a loss, or you make bad loans to bad credits, your TAM is almost infinite. People will flock to do business with you.
100%.
And so when people value these companies on revenues or potential revenues, you have to understand that the revenues are inherently unprofitable. Give away $20 bills for $10 on the street corner. You will have an incredible growth rate. And so this is trying to separate the wheat from the chaff. Really, right now, they're all going up, right? The legitimate businesses are going up with the absurd structurally money-losing businesses. And so, it's going to take some patience, I think, and structure in your portfolio to figure out what to be long and what to be short. But there certainly is no shortage now of crazy TAM stories. One of my favorites is the sports betting market. I mean, people have just discovered sports betting. And, I'm guessing you and the boys have put a few wagers on games, maybe once or twice in your life. The sports betting total revenues in the U.S. sports betting market last year was under $1 billion. That's the win, not the handle. That's the amount that the companies kept, not the amount bet. It's probably going to be closer to $2 billion this year. And we have roughly 40% of all the states doing sports betting. But the total U.S. gambling market's $80 billion. It's been growing at about 2% a year forever, basically growing with inflation. Now, the TAM for sports betting alone, if you believe the bulls, over the next 5 to 10 years is supposed to go to $30 billion. Well, that $30 billion is going to come out of probably the general gambling take. It's not going to be additive. And so I look at these things and say, okay, well, you basically are thinking there's going to be a 30-fold increase in the market to justify the valuations. And a lot of these companies will still be losing money 5 years into this growth rate. And sports betting is interesting. If you ever go to a casino, and Keith, I don't know if you've ever been to a casino, but the smallest amount of real estate in any casino and the least attractive amount of real estate in any casino is the sports book. It's the least profitable part of any casino.
Yep.
The win percent is about 5 to 6% versus 13%, 9% overall for a casino and 13% for slots. So again, this is not a great business. Sports betting is not a great business. I don't know of any bookies who've gotten fabulously wealthy, booking sports bets. It's amazing to me. But we've now created a TAM story around people betting on football.
Well, I mean, depending on what your proclivities are and the risks you're willing to take on an orange jumpsuit for life, there being a certain kind of a bookie can be quite profitable to a certain person, but not as a public company. I mean, it's I'm assuming that you're short DraftKings. Is this the name?
Well, I'm not going to mention what we are short some of the casino companies. I will say that because they've got additional problems, particularly the Las Vegas casinos. And I've been a big bear on the Vegas casinos for a while now, not because of COVID. COVID has certainly made it worse, but there just is more and more competition for what was Las Vegas, which was a unique destination for years and years and years. Atlantic City was never really the competition for Las Vegas. And Las Vegas expanded well beyond gambling, about 20 years ago with the advent of the Bellagio and the Mirage. And now it became a place to go have dinner, have great restaurants, nightclubs, pools, that whole thing. Well, I'm talking to you from Miami. Miami has that right now without the gambling. Yeah. Millennials aren't big gamblers. And so the peak for strip casino gaming revenue was 2007. Mm-hmm. And so Vegas has had to basically compete on everything else, conventions, pools. But again, it's a no-growth market, and people are putting increasing multiples on the casino stocks because they're hoping they're going to get online and do a lot of other things. But if you actually look at the fundamentals, the numbers, they're stunningly bad. And I think sports betting is going to grow pretty rapidly for the next couple of years as the states implement it. But once you get 30, 40 states implementing it, you'll see the market slow down. And it's not as if we don't have online gambling. The UK and the EU have had it for years. Yeah. And William Hill is just being bought out at a fraction of the price of where the US guys trade at. It's not as if this isn't a known market. If we gamble as much as the Brits do or the Aussies do, two of the most gambling mad, societies out there, the total amount of win in U.S. sports betting will be about $4 or $5 billion, and that's if we gamble as much as the Brits and the Aussies.
Well, I think
I think the 30 billion number.
Yeah, the TAM. I mean, when you reverse engineer the TAM, that's the best way to start with these shorts. At least, our analysts would certainly agree with that. MGM's a stock that we're short, so that I think kind of fits the profile of having a significant exposure to the strip. Or there are a lot of businesses like that, Jim, where baby boomers' product is not, to your point, what millennials would consider something that they want to go smoke some darts and twist the handles on slot machines. That's just not what they're doing. So there's a lot of evidence, like at least we would say. I guess back to, you're not going to give me the ticker on that. I put in flip for the house flipping SPAC, but I couldn't. Ironically, nobody has the ticker flip. That's not a ticker. That's not somebody's picked.
I think it still has the. I still think it has the ticker of the holding company. They haven't changed yet. It's IPOB.
IPOB. Yeah. Okay.
But and the company is Open Door.
Now,
but
now, what a
again,
name for a company that is! It says Social Capital Head of what? I mean, that is Head of Sophia. That's got a long name.
Yeah, it's a well-known promoters companies. All of his companies have that name.
Oh, cool. Sounds cool.
You can look it up.
I did. All right. Well, yeah. On something that sounds like the way that you explained, I'm going to sell you something for X and just lose money on it perpetually, but tell you the TAM is large. I mean, I think we all know what company has done that with the most market cap currently today, which is Tesla. So I mean, that thing. Like I actually just shorted it today because I'm like, this actually fits my profile, which is what I said, Jim, which is it finally stops going up. That's identifiably, my 4 kids could tell you when the bubble pops, in the yard, they got to blow another one. And it makes a lower high, and now it's sitting there, and the short interest has actually fallen. And a lot of people are scared to short that stock. I mean, most people are scared to short that stock.
Good reason.
Are you?
Well, at least the recommendation I gave you last year worked out so well. It's look, this is the poster child. We're still short. This is the poster child for this bull market. I don't care what anyone says. This is the stock upon which investors, TAM investors, retail investors, algorithmic investors, everybody is putting their hopes and dreams on this one company. And it's not just EVs, it's the whole ESG mania, which he fits in perfectly. I'm the green company leader. And when you tell somebody it's a car company, they'll tell you it's a tech company. But then they'll point to their sales of cars in China. And so it's like this piece of mercury that just constantly moves around. Every time you try to just say, well, look, it doesn't make money selling $50,000 cars, and never has. Then people will transition to, oh, well, it's an energy company. Or now I love the latest one. It's a battery company.
A battery company.
When you point out that battery companies trade at 8 times earnings in Japan and Korea. Well, then now you don't get it because they've reinvented the battery. And I joked when they had Battery Day a few weeks ago that there were no batteries at Battery Day. They literally didn't show anything.
That was like when they. Go ahead.
Yeah, this is a narrative. This is a narrative. It's a $450 billion narrative. It's really, you can't justify it any way, shape, or form in terms of the fundamentals at this point. So it's hopes and dreams. I pointed out, I think on Twitter about a month ago, there was an analyst who raised his price target some ridiculous amount of money or percent, and he hiked his revenue figure some just dramatically going out 5 years. And then when you looked at his discounted cash flow analysis, he hadn't increased his CapEx spending for all the factories that were needed to get to that revenue number. And this is what's passing for analysis these days. And nobody cared that just I'm going to change numbers because the stock price is higher, but I can't really tell you how I get there because you can't get there.
Yeah, you don't need to get there.
So
it's just like you did.
Yeah, and you haven't needed to get there.
Yeah, what's interesting about that one, I mean, it's most recently found its way. I'm not sure if you're familiar with it, but the Goldman Hedge Fund Hotel, long book, which is basically the ETF, the GVIP. So I'm like looking at this thing. I'm thinking, okay, I think the bubble's starting to pop. I do have a view on that, because I'm still young enough to screw it up another time. But I mean, it's or maybe not. So I'm looking at this hedge fund hotel book, and Tesla is the number one long. Okay, so it's the number one holding in the GVIP, the ETF, is Tesla. So it's not just, and there are a lot of different ways that you could say that came to be. You could say, well, hedge funds, are kind of in the ha-ha trade. It's got price momentum, it's got the attributes that the machine itself likes, and they don't really care for the analysis. They're just playing the momentum, or a series of other reasons that could be. But it's different than the sell side being negligent on the numbers. I mean, that's the buy side, right? I'm going to put my LPs in this because of price momentum, and we're just going to run over Jim Chanos and the rest of the people that are, like, haha.
Well, I would be curious. I could be wrong. Someone could check this. I think it might have been in the Goldman Sachs short basket a year ago. Most heavily shorted stocks.
A year ago,
or
yeah.
hedge fund short basket.
A year ago, yeah. I would.
Yeah.
I'd have. Don't need to fact check that to believe that. But now, but now it's in every price momentum basket on the long side. And the only thing you need to eradicate price momentum, as you know, is high and rising volatility. So I can't for the life of me say, like, why wouldn't I short one of the biggest, basically story stocks in the history of humanity? This would be like Tulips had as good of a story as this, I'm sure, but there was no machine perpetuating the upside. It still went there. You end up with a place, as long as NASDAQ volatility's got a 3 in front of it, why wouldn't you short Tesla? I mean, the catalyst to me is that it's going down. Let's start there. Do you think that's a fair point, like as a catalyst? Because people are going to say, Jim, what's your catalyst?
Yeah, I mean, again, every market is different, but this market analog to me most resembles early 2000, and they started going down, and although the S&P I think made a higher high in summer or fall of 2000, NASDAQ didn't, and the story stocks really didn't. And every leg down on the S&P, they went down sort of 2x to 3x. People forget the S&P was down 40% from peak to trough in 2002, and NASDAQ was down 80%. So it was every bit as bad, if not worse, than the GFC in 08-09. And I think that we'll have to see. I mean, we have much more leverage right now, given the call volume trading that's happening at retail.
Yeah.
And so this thing could any of these story stocks could drop very quickly on a change of sentiment, and we'll just have to see. We'll just have to see how that plays out. But I do think it's hard to ignore that Tesla is the one stock that people are putting hopes and dreams on, and sort of disregarding the sort of ugly fundamentals of the car business.
Yeah, 450 billion. Actually, today it's four. When I shorted it, I had to make sure that it still had a 4 in front of it. 419 billion. And I'll remember that. We'll see. Let's see. And one big pushback people would have, and this is a great tweet that you had the other day. I think you're tweeting at a guy named Joe. I think I know who he is. On October the 7th, a lot of people will say, well, it's the Fed. You got to buy Tesla. Okay, whatever. But someone you tweeted, someone please tell Joe that the Fed bailed out markets and banks in 2020, 2008, 1998 LTCM, 1990s SNLs, and 1982 the Third World. I think you're the only short seller alive that was short selling successfully in all those periods.
Yeah. I started in '82. I was an investment banker for 2 years, and then I decided to get on the straight and narrow and go into short selling at the market bottom in '82. So that gives you a sense of my market time. But I remember all those, and I remember that we've been having bailouts now for every sort of 8 to 10 years.
Yeah, that's not the buy signal. That is the beginning of the end signal. And I've been fortunate. I've only been able to trade through 3 of those. This being the third. IBM. This actually surprised me when I was getting my kind of prep pack on you. Those kinds of slow moving animals I quite like shooting at personally. But I didn't know what the wrap was on that.
Yeah, IBM is so. We love the conceptual, lose money on every transaction stories, but those are all discretely very small positions because they have to be.
Yep.
But one of my favorite positions, one of our largest positions, is good old IBM, a company nobody's ever heard of, and it's a really interesting story because it's the ultimate value trap, and it's been the ultimate value trap. We were short this thing back in 2014, 2015 when we realized that there was no way Ginny Rometty could deliver on $20 a share, and the real earnings were well lower than that, and they would have to reset expectations. And in fact, that's exactly what she did in 2015 and 2016, and fessed up that the real earnings power of the company was really $10, and the stock went from 200 to 120. We covered our short. fast forward to today. Ginny has been kicked up to executive chairman. Arvind Krishna is the new CEO. He's an IBM pretty much lifer. But here's the interesting part of the story. If you look at IBM's economic earnings, what we call economic earnings, they're supposed to earn about $11 this year, $12 next year, $13 in 2022. If you look at operating income plus IP royalties minus interest, taxed at 21%, the current number is about $6.40.
Wow.
IBM has made the remaining $4 on tax credits and all kinds of one-time items. The number is going to be probably $5 and something next year and $4 and something in 2022. IBM normally trades at 10 times its earnings. It's currently trading at more than 10 times the expected estimates. But the reality is this company is earning half of what they're saying they're earning. And the question is, how do you bridge that gap? It's one thing to turn $6.40 into $10 and change. It's another thing to turn $5 into $12 and $4 into $13 in the next 2 years. So we thought that the company would have to reset expectations, and the new CEO would come in and do what Ginny did in 2015, 2016, and say, look, the cloud is actually hurting us. IBM is the anti-cloud company. As much as they claim they're a cloud company, the cloud is killing them. Revenues are declining every quarter, year over year, and they've cut all the costs they can cut. That's why the operating earnings keep dropping. And so we thought they would reset expectations, cut the dividend, bring down expectations to reality, reset stock options for the executives in the C-suite, because you can't get good executives at this company. They get stock options and the stock just keeps melting lower over the years. Instead, he did the exact opposite a week or so ago.
Yeah.
They announced another Giulio Rametti-like split where we're going to spin off the crummy business, keep the good businesses. The problem is in most spin-offs, you spin off the crummy business and you keep the growth businesses. But IBM is so structurally impaired, they're spinning off the really bad business to keep the bad business. and so both businesses are going to be declining in revenues. And this doesn't solve anything. But what it does do is enable them to take a bunch of charges, which they've already admitted they're going to do, and call them structural, and then add them back to adjusted earnings. So we now know how they're going to try to bridge the gap in the next sort of 18 months between the real operating earnings, which are going to be $5 to $6, and the stated earnings, which are supposed to be, $12. They're going to do it through charges of real operating costs, and then claiming that these are extraordinary, and then add them back to adjusted EPS. This is just an accounting scam, and it's a really obvious one. All you need to do is just open up the 10Qs and read the numbers, and you'll see that IBM is earning literally half of only what they say they're earning.
Wow. And this thing only
simple story.
And it's got over $100 billion in market cap. It's got a 2% short interest.
Oh, yeah.
2% short interest, and they're ostensibly the 5% dividend. I don't know if that's. You're saying that's obviously not real, but they're going to try to pay it.
Yeah, no, and they shouldn't, because obviously what they're trying to do is thread the needle of not cutting the dividend. They won't be covering the dividend as of next year from real operating earnings. They've got a huge amount of debt here. This company took on debt to buy Red Hat.
Right.
$34 billion. There's almost $50 billion in debt. So the total enterprise value of this company is about $150 billion.
Woo.
It is very large. The debt is right now about 6 times, give or take 6 times EBIT. This is a company that was AAA that is beginning increasingly to look too levered. And then you just have the basic problem that any company where revenues in technology, where revenues are declining 4 or 5% a year structurally, is dying. I mean, tech companies should be growing or they die. This company is shrinking, and it's shrinking because it has a lot of legacy businesses that are just old, consulting businesses revolving around IBM constructed systems that are just way too antiquated. And as I joke, the cloud is actually their enemy. They are not in the cloud business. The cloud is their problem.
It's amazing. I mean, it reminds me of, again, not the same story, but the same, I guess the same meme, which is General Electric. I mean, you go back to that stock,
Yep.
Versus where it is today. These melting ice cubes and value traps, and you do a great job like antagonizing value investors because again, you don't just buy it because it's cheap on the wrong numbers. I think you've taught me that. I mean, you do a great job teaching at Yale and teaching to people. This whole thing that you learn in business school about I'm going to buy cheap stocks, I'm going to short expensive stocks. Like even if you take the Jim Chanos view in all of its singularity and say, hey, look, I have this view on TAM, and I'm basically still even going to fade that a little bit here because these guys don't even have any access to the cloud TAM. These guys are they're going to melt away. I mean, that to me,
they're actually, all the money that's being poured into cloud and business applications and software as a service actually hurts IBM. They're not on that cutting edge. They're actually the roadkill. Everybody's going after their business. And that's the problem here. And they're just stuck in this 1960s, 1970s, 1980s mindset and can't get out of it. And I think that again, all you need to do in IBM's case is just look at the numbers, read the 10Ks, read the 10Qs, and then just look at how much of the earnings are coming from below the bottom line. I mean, this company has basically been barely paying any taxes for the last 10 years.
Wow.
Now, I know that there's innovative tax planning you can do, but if you don't pay taxes for the last 10 years, I'm going to say that you probably structurally aren't very profitable. and just, again, you don't have to believe me. Just go back and look at the numbers.
Yeah.
And so this is a company that has been about financial engineering and not software engineering. And I think that's the real problem with IBM. But Keith, it gets back to the numbers. I mean, there are lots of interesting structural shorts that are basically still accounting shorts.
Yeah.
Where you can look at the data. We've been short the fracking space since 2012, 2013 with Chesapeake Energy, and it still amazes me that when you look at the financial statements of the domestic E&P companies. We're short Continental Resources, an old favorite of mine. We've been short this now for a number of years. We talked about it, I think, 1 year at Seeking Alpha. And these guys are writing off their capital base still over 14 years. So everybody values the energy space on EBITDA. But if your depreciation and amortization is fanciful, and anybody in the fracking business knows the wells don't have a 14-year life. Right? They decline massively in the first year and then tail off. And if you're charitable, you would say that the fields have a 6 or 7 year economic life, but practically it's actually much lower. But almost all of the companies have double-digit lives on their depreciation schedule, meaning 12 years, 14 years, 15 years.
Ridiculous, yeah.
And it's just insane. It just means that the whole industry is fraudulently reporting its numbers.
Well, Wall Street gets paid on the other side of that, right? I mean, you can issue debt as long as you're willing to suspend belief on a stated EBITDA number that's complete bullshit. I mean, we know, that game. It's amazing how so many components of the game, like whether it's the debt bubble, the TAM bubble, they're actually all interconnected at this point. That's why I think when people ask me about it can't be the .com bubble, I'm like, it's absolutely not the .com bubble. Don't give it that compliment. This is way bigger, and it's way more entrenched and it's an amazing thing to watch. It's an interesting thing now that you say you compare the Tesla short to the IBM short. It's like at least with Tesla, nobody's debating if the company has any cash flow, right? I mean, there's nothing. Whereas IBM is you're just pretending that you have a certain amount of cash flow, and you do have the cash flow, but it's just declining. It's just declining at a terminal rate. Yeah,
and so it's a little bit, it's a different story. But The problem with IBM again is that people are buying it as value, and they haven't really dug down under the numbers to realize it's actually not what it says it is. It's half of what it says it is. IBM's not going out of business tomorrow. On the other hand, it is only half as profitable as they say it is.
Yeah, that's why I compared it, again, just anecdotally to the GE short. I mean, melting ice cubes melt. I mean, and that stock price has obviously done it. Some questions here, if you don't mind. I'm just going to rattle off a couple. One is actually one of the top-rated questions. Has to do a little bit with what people are probably thinking. Well, aren't there any, adults? Aren't there any like fun cops out there anymore? Sven from DC says, do you think the SEC is too soft on companies? Is there an element of too big to fail on companies like Tesla, like even Tesla here?
Yeah. Well, Sven, you're in Washington D.C. Why don't you go check? I teach a course on the history of financial market fraud, as you know, up the road, and this goes in cycles. And I've always said that the greatest defense attorney and the harshest prosecutor for any publicly traded fraud is the stock price.
Yeah.
In that people don't get upset and don't weigh in politically, i.e. something has to be done, throw the crooks in jail, until they start losing money.
Mm-hmm.
And the fraud cycle follows the financial cycle. It's one of the things I teach. And it's not until it turns down, and this goes back as long as there are financial markets, back 400 years, Keith. People don't tighten up and begin to worry about more regulation or legislation or prosecution until they start losing money. And once they start losing money, then there's a general change in the marketplace and in society that it's not my fault I fell for this. It's the scoundrels who put me into Enron and Adelphia and Tyco and WorldCom, and something has to be done. And so we see these waves of outrage and legislation prosecution well after people have lost money. Mm-hmm. And that's as old as financial markets. While things are going up, people suspend their sense of disbelief, and they believe things like TAM that are too good to be true. And it's only later that we find out, that not only were the hopes and dreams incorrect, but that there was theft and fraud going on.
Yeah, I mean, that's you just watch when Tesla was working on the short side. Back when Portney was ripping his hair out, yelling at Elon. People are going to lose their shit if this thing starts going down. That's why I say the catalyst is that the thing's actually starting to go down. Another question on this on this topic, and I think that this really has to do with people. A lot of people believe that you are going to be right big time on Tesla, me included. Like what short, Jim, took, this is from Ashley in Minnesota, which short in your career took the longest to fully realize the gain?
Yeah. We had a bunch of shorts that on the Mike Milk and Drexel complex in the 83, 84, 85, when we began to see what was going on with that, and that there was a lot of financial fraud going on under the surface, and that didn't break until 89, 90. So that was 5, 6, 7 years where we went through a lot of volatility and a lot of stocks went up a lot before they completely crashed. Certainly, my foray into America Online was memorable. It was very Tesla-like. That one we got out at exactly the top, pretty much, after the stock went from 8 to 80. I think it finally got bought out at 100, and then watched it, basically torpedo two companies, AOL and Time Warner, and that was an accounting story, but it was also a TAM story while we were short it, and right. And so nobody cared until it stopped growing, and then Time Warner bought them, or they merged with Time Warner, and then the whole mess sunk Time Warner. So we'll put that one in the sort of undecided camp. But this has been the longest in terms of I think just the length of time of which some of these stories, where there's very clear problems, where the markets just shrugged it off. The late 90s there were a couple of situations like AOL, but not as Keith said, not as many as today. And most of them didn't really start getting crazy until 98, 99. So you had about a year and a half of pain in those situations. And this has gone on much longer.
Yeah, this is the last question. Unfortunately, we got to wrap it up here. But it's amazing that I'm even asking this question. That these are questions that it's kind of the suspension of gravity type question. Ethan from Jakarta in Indonesia, what prevents fraudulent companies to be able to continuously raise capital either through selling debt or equity?
What prevents them? Well, I mean, nothing prevents them other than, I shouldn't say that. And I don't know, maybe Ethan from Indonesia is a fugitive from justice. We don't know, but nothing prevents them per se, other than the marketplace, unless, of course, their law enforcement steps in or the regulators do step in, which is pretty rare, as I indicated. Yeah. You have basically... that generally happens after the fact. And so I think that the marketplace really, it's either sort of all or nothing in these kinds of companies. They can either raise tons of money like they are right now, or they can't raise money at all when the market shuts down for them. And there's sort of no middle ground. And we're in the phase right now where they can raise tons of money. And if I was advising them and they had questionable business plans, I would be telling them to be raising as much money as they can.
That's exactly what happened with SPACs. Like you said, 4 or 5 a day. If you're going to keep the game going, authorities and establishment and the elite of Wall Street, which went to school with you and I. It's not like they're all really happy about this discussion, by the way, Jim. But I think we did well for the people today. So thanks for all your wisdom and all your thoughts. I know everybody appreciates it.
I'm so happy to do this. Good luck and thank you.
All right. Thank you. He's the one and only Jim Chanos. A real conversation that was. We'll be up next here in about 10 minutes.